What's up, guys? Welcome to another FoFty episode. I hope you're all having a blessed weekend. And today I've prepared a very special episode for all those watching out there because the market and the economy is at a very important inflection point. And when we get to these junctures, it's really important for us to take a step back and assess what's going on before the change happens. And mark my words, the changes coming down the pipeline are going to impact all of us in one way or another. So let's get down to the reflection here. So I've prepared this, we're not going to just go rambling off on random topics here. I've actually prepared an outline of what we're going to talk about in this everything at all-time highs and why this has never happened before and why it can be dangerous episode. And the 8 things that we're going to talk about here are the things that are at all-time highs, which are stock market, the housing, the money supply, Bitcoin, the national debt, and gold. These 6 things are at all-time highs, which is an amazing thing if you think about it. And then we're going to talk about 2 things that really matter in the upcoming months, which is the CPI and jobs data. And so these 8 things are going to drive the conversation today. And let's get to it. So the first thing we want to talk about is stocks, right? Now, as you know, stocks have been on a rampage. They have done nothing but go up since April. But at the same time, we also know that stocks are not necessarily the main street or the real economy. And that happens because there's a lot of speculation that goes on in the stock market where people front run potentially good news and also bad news. And in this case, good news, where the valuations are just rocketed up higher. And that's currently the situation that we find ourselves in. Now, if we look at the first chart that I've prepared for stocks, it just exemplifies what I just described about how stocks don't necessarily mirror what's going on in the real economy. And the real economy in this chart is the simplest one that I can come up with, which is the jobs market, right? Because ultimately, the jobs drives the real economy, which drives expenditure and spending, which is over 70 and 80% of the economy, and so on and so forth. And that is represented here by the blue line. And what we can see here is actually since about early 2021, right, the job openings of the real economy have gone down. Now, granted, it went up because of the COVID lockdown, and then we had that huge spurt up where jobs were created, but we've actually given all that up and are in a downward trend. The stock market here is represented by the S&P 500, and you can see in this red line that it has done nothing but go up, particularly, in the past few years. And more specifically, if you look over here, after the tariff meltdown that we had, this little line up here has just gone straight up. Now, if you look at this, normally both track each other. Why? Because the stock market goes up when jobs and the economy are going well, and when the jobs and the economy aren't going well, and we go into the recessionary periods, which in this chart are green bars, they both go down in tangent, right? The last thing I'll mention here is the unemployment level in this chart. And you can see whenever it starts to go up or starts to curl and starts to go up, COVID being the example where it just rocketed up because of the artificial lockdowns imposed on us. But here we see it's curling up. We've also had a recession. So, and we're looking at data for almost 2.5 decades here, right? Since 2000. And we've seen basically 2 real recessions and 1 artificially induced blip of a recession because of COVID lockdowns. And this huge dichotomy, right? This huge spread between the jobs and the S&P 500 is where we're currently at right now. There's a huge disconnect. So ultimately, the first point I want to make is that yes, the stock market is going up and it can continue to go up. But as it does, the real economy continues to deteriorate, which we'll talk a little bit further. And this spread, right? And this difference between the stocks and the real economy continues to grow. And this will not last forever. It has never lasted forever in the entire history of financial markets. And there will be at some point a snapback where the both are once again tethered to each other, driven by the reality of valuations and the reality of the economy. And that is going to happen one or another. Either the economy just rockets back up and the stock market has been right, or the stock market comes crashing down and the real economy is right, or a little bit of both. But they will not stay this disentangled from each other forever. It's just not what's going to happen. And so the jury's out on what's going to happen. But one thing I can tell you is that the unemployment level and the deterioration of the economy is ratcheting up with the latest jobs data that we've gotten. Now, the other thing that I wanted to show in stocks, and I'm only going to show two charts for stocks because there's no need to do a deep dive on this, is it has to do with the sloshing around of money into stocks, right? And so what this chart shows you is the percent, okay, of money, and money here is measured in M2, money supply. And without getting into the details of this, which you can look up yourself if you want to geek out on it, M2 is essentially what we understand to be the amount of money in the economy tends to be something that we call M2. There's M1, M2, M3 and all that, but let's just stick with M2 because we're not going to geek out on it. And what is the percentage of that into the NASDAQ, which is not all of the stock market, right? It's the NASDAQ, there's the S&P 500, there's the Russell 2000, and it goes on and on. But just in the NASDAQ market cap, the last time we hit this level was in the dot-com bubble, right? It just, when we had a crazy, everybody was putting all their money into the stock market back then. That had this crazy vertical line up, which obviously popped, and we had the vertical line back down. We've had other situations where it's going up, right? Where, it popped and went down, it popped in the, but we are at an all-time high at 160%. We have never had this much, okay, of the money supply ratio to the market cap of an index such as the NASDAQ this high in history. And so that tells you that there's a lot of money that's been sloshed and parked into the NASDAQ and other, actually, not just the NASDAQ, I just picked that one out, stock market indexes. And the bottom line here is that what that tells you is that a lot of the cash floating around the world has been funneled into the stock market, and there's that imbalance, which is why the stock market valuation is also so high, because as more money is chasing it, right, the valuation, you would think, would go up, and it has. And so that is the current state of the stock market, which is that it's essentially detached from reality, as I've shown you, and its valuation is extremely high right now with a high concentration of the money supply parked into the stock market. Now, the second thing I wanted to talk about is where housing is, because housing has also moved into a stratospheric level where we're now at all-time highs. And the first chart I want to show you is just a straight up home price history, right? Now, this is just literally the price of homes adjusted, right, relative to the CPI, where we're at right now. And what this chart, this simple chart is telling you is that we're also at an all-time high. In fact, the home prices have increased and shot up above the 07-08 housing bubble that we saw pop and cause a lot of pain for homeowners and everybody else, actually, because that in turn caused a recession. A lot of people lost jobs. And that was at around 266 was the peak back then, right? In 06 before we had the crash. Well, here we are. We're at 300, okay, in 2025, and it looks like we're not going to go much higher. We already had this adjustment, and I'll show you more data in a bit, that this is now starting to curl over. So, the astounding thing to keep in mind is while the stock market is at all-time highs, we've never been this high ever in the stock market with the amount of money sloshed into the stock market, never been as high ever. The housing market is also at all-time highs where the prices of houses has never been this high, even adjusted for inflation with the CPI. And if we take a couple of steps over here and look at the next chart that I want to show you, hold on, let me cycle to the next chart here, is that the affordability, okay, the affordability, which is the mortgage payment to income ratio, so how much you make and how much the average mortgage payment is to buy a house for the average house, has never been this high. Again, it's higher than it has been, right, during the last bubble in 07-08 at almost 40%. So now we're at 43%. So basically what this is telling you is almost half of your money that you make needs to go in to pay for your mortgage if you're to buy the average house, right? Your average income and your average house prices, almost half of it goes into mortgage payments. And that doesn't take into consideration any of the other stuff, which is your insurance cost, your tax property, your maintenance costs. Things break, right? In houses, and any like housing or DVA costs for, if you live in a community, all that is layered on top. And it has never been this high. So basically the affordability of people to buy a house has just cratered, right? It's just almost half of your income just goes right to housing. Forget about food and everything else. And what that has led to is that there's basically no demand for housing, right? I mean, the only time that housing demand actually cratered was the lockdown-induced crash we had back during COVID. But we're at this levels now, right? Like, there's basically no demand. There's no pending homes. Nobody's buying because nobody can afford it, and housing prices are so high. And throw in the fact that mortgage rates have gone up, not gone down, since the Fed cut rates in August before pausing last year. You have the situation where there's just nothing going on, right? Nobody wants to buy, right? That's beginning to change as now housing prices are starting to go down and there are some more transactions. And if mortgage rates go down, then, well, you'll have even more housing price decreases and increased transactions, which I discussed in my earlier episode. So, like I showed you earlier with the stock market, where the stock market and the real economy have just winded the gap between the two and they'll snap back eventually, there's also a gap in the housing market with home prices and mortgage rates. And what that's showing you right now is there's never been like such a huge gap between home prices, right, and mortgage rates. And this also will eventually snap back, right? Either one will go down, the other will go up, or they'll both meet in the middle. But what that tells you, though, is housing prices is going to go down, right? So home prices are probably going to go down. They're not going to go up forever. They're going to go down. How much will it go down and how much mortgage rates come up or go down is a question, right? But here's the thing. If you think mortgage rates are going to go down, that means home prices are probably going to go down even further. And this recalibration is something we're just seeing the beginnings of in the illiquid markets of houses, because as you know, transactions in houses take a long time to complete. Now, housing prices have already started to come down, right? Even since the peak in some markets since 2022 after COVID, for example, in Austin, right? Home prices have gone down. And we've seen this not just in Austin, but now we see it in Florida. We're seeing it in the Midwest. And we're seeing this starting to percolate around other parts of the country. And, while some parts of the country are shielded from this because everybody has gone back to, work from the office again, so like the Northeast, like Boston, New York, and those places haven't hit. But you'll see this starting to metastasize around the country, and eventually even those places will get hit, right? Because it takes long for these changes to happen in the housing market due to the illiquid nature of it. So the second point here is housing has just hit an all-time high in all ways you look at it, in prices, in the record lows, in volume and sales, and the affordability being at record highs again. I mean, every which way you look at it, it's at all-time highs and it's beginning to curl over. And this is a very big factor into the economy because by and large, how rich people feel is a lot of it is locked into the equity in their home prices. And if their home prices start going down like they did in 07-08, they're going to start feeling poorer, which means they're going to start spending less. And there's a lot more in housing that I didn't get into because that's like a whole episode in of itself, how people are taking basically loans out of their home equity and so on and so forth. There's a lot of data out there showing you what's happening. But basically, that's going to be a big chunk into the slowdown of the economy if housing prices continue to accelerate downwards, which we're already seeing the beginnings of. Now, moving along, The next thing I wanted to talk about is the money supply, and that is at record all-time highs. And money supply is important to talk about because that is, if they pump and create money out of thin air, right, that has to find a home somewhere, right? It has to go somewhere. And what the Fed and central banks, what they don't control is where the money goes once they print it, right? And unfortunately, what has happened is that money has gone to the top 0.1%, who have gotten a lot richer than everybody else, where the middle and particularly low-income class people haven't seen any of the printed money. All they've seen is them getting poorer because of inflation, whereas the rich have gotten richer. And so the spread between the rich and the poor continues to grow around the world. And you're seeing, and I'm not going to get into the politics of it, but just look at the news, whether it be what's going on in Nepal, whether what's going on in other parts of the world like Indonesia, where they're just sick and tired of, the poor are just so sick and tired of being poor while the rich get richer. You'll see this continuing around the world. Now, let's talk about the money supply. And what is going on with the money supply? Well, basically, ever since 2000, we've gone on this crazy printing, this is central banks just printing, right? Money, in the global money supply. Now here we're measuring broad money. So I mentioned how there's M1, M2, M3. This one is M1, not M1 rather, but M2 plus M3 in all currencies around the world, right? And we're at basically $140 trillion, which, I mean, it doesn't calculate. You guys don't realize how big $140 trillion actually is. But the point I'm making here is we're just printing more and more money. There's no stopping to this, right? This is a runaway train. And when you break it down into not just the entire world, but countries, you'll look at, it's not that just the US printing money into new all-time highs. Look, this is into 2025, so this is the latest data. US printing money into new all-time highs. It's China doing it as well, all-time highs in China. Europe is doing it as an entire continent and block. Japan's been doing it, representative of, this large economy in Asia. I mean, everybody is just printing more and more money, right? And so what does that mean? That means that, like I said, all this money printing has to find a home. And as I've shown you, they've found homes in the stock market, right? With the rich getting richer. And also, to some degree, in housing prices, right? We're seeing that as well. And so, all this printing of money has also got into other asset classes, such as Bitcoin. Now, we need to talk about Bitcoin because as much as you want to deny that it's a Ponzi scheme and it's going to go to zero, the fact is, ever since its creation, it hasn't disappeared. We've seen other things disappear, like NFTs, right? Remember all of that, and all the other versions of essentially the underlying blockchain technology have come and gone, right? But Bitcoin hasn't. And that's just something to acknowledge, right? And if it was a Ponzi scheme after its first blow up, where it lost like 70+% of its value, that should have been it. It should have never risen again, because there is no Ponzi scheme ever. And I challenge you to find one of a Ponzi scheme that after it popped, where it's like 70% crash after, it just died, it has never come back, right? And that includes the tulip mania, that includes any other Ponzi scheme. Once it pops, it's gone. It's like a one-hit wonder. That's it. It never comes back. But that's not what's going on with Bitcoin. So you have to acknowledge that fact, right? If it were a Ponzi scheme and it popped and lost 70% of it, it would not have come, and it has done this multiple of times where it popped, lost like 70% and came back, even went higher. That has never happened to any other Ponzi scheme ever in history. So if you don't believe in Bitcoin, that's fine and all that, but you literally cannot call it a Ponzi scheme, okay? Because it just isn't, right? For the factual information I just shared with you. Now, whether it's a speculative bubble and all that, I don't know, right? It could be. It could be. And we've seen it go into a frenzy and pop it. But it hasn't gone away. That's my point here. It hasn't gone away, and chances are it's not going to go away, right? Because there's just more and more entities using it now, including now there's ETFs and corporates and BlackRock and all this compared to before. So the chances of it just like going away are diminishing as time goes by. That's another fact you have to acknowledge, right? Because of the larger adoption of Bitcoin, basically, compared to the past. So the trajectory of adoption is going up, which means the chance of it disappearing goes down, right? Now, if we talk about Bitcoin, and I haven't really spent much time talking about, and I do have holdings in Bitcoin. I got in around 30,000, so I'm looking pretty good here. But look, in the Bitcoin community, one of the things they look at is the Bitcoin to global M2 money supply, right? And they do an offset. Yes, I am a Bitcoin maxi. They do an offset about 80 days and they chart it over each other. And what has shown is that, it tracks the M2 money supply. Like I'm saying, when they print money out of thin air, a lot of it goes into Bitcoin because Bitcoin, well, it has its fundamental reasons for existence that they will tell you, is also a speculative asset class, meaning people get into it to make money, right? There are a lot of people who do that. Then you'll get the religious people who are there because they're going to hodl forever until, this whole system blows up. That's too, but make no mistake, it has been following the M2 money supply, except for very recently, which is why I've been very cautious about Bitcoin, because all of a sudden, money supply kept going up, but Bitcoin kept going down. Now, most recently, it's been going up. So a lot of BTC people are saying, wow, now it's going to play catch up and go up. And it could very well follow the M2 money supply and catch up. Now, that's very possible, right? I can't say, I don't have a fortune, teller's crystal ball here. But this did concern me, right? But will it go up? I mean, it did save it over and go up. So there is a very good chance that it put in a bottom and we're going to follow and snap back right into the path that M2 money supply is falling right now. The other chart I want to, or newspaper headline I want to show is like, okay, so I talked about the, where Bitcoin goes, but, back in 2009, after the great financial crisis, where we almost had a complete implosion of the stock market and financial markets, the banks started printing money, and that's why Bitcoin came into existence. And this was the literal headline, Chancellor on brink of second bailout for banks. People just, whoever or whomever the group is, Satoshi Nakamoto and all the, Bitcoin was created because of the money printing that banks were doing. And people are saying, like, you can't just do that. We're not monopoly money. We're not playing a game of monopoly here, creating fake money, and just can't do that. Right now, the gold bugs, like I am, have known this for a long, long time. Right, but there's a new class of people with new technology and digital gold and all this stuff happened because of that. And I bring this up because, let's not forget that in Bitcoin, there is the Genesis block, and you see that same, right? Chancellor on brink of second bailout, Jan 2009, right? This same headline in the newspaper was stamped into the Genesis block of Bitcoin so that we will never forget the reason of why Bitcoin was even created to begin with. And for me, that's really cool, because if you understand blockchain technology, one of the things about blockchain that makes it really, valuable is that there's this property they call immutability, which basically means once it's written as such on the blockchain, you can never ever change it again. It is set in stone for eternity, right? So it's a really good recording of what happened. That's one of the benefits of the underlying technology of blockchain. And blockchain was created specifically for Bitcoin, right? That was the use case for blockchain technology, was Bitcoin, right? Now, a lot of people, there was this whole period where, hey, we did blockchain diamond certification, blockchain this, none of them really worked, right? None of them really worked. Honestly, many years now into the blockchain hype, what has stuck? Nothing, except for one thing, and that has been Bitcoin. And in the blockchain Genesis, meaning the very first block, the Genesis block, they put in that newspaper headline so that none of us will ever forget why Bitcoin was created, right? And to me, right, as a gold bug and, and all that, I find that really cool, and I'm totally down with it. And, I'm both a gold and a Bitcoin proponent for this reason. It's that reason that drives gold and Bitcoin that's in the Genesis block of Bitcoin also, is this whole, money printing monopoly thing, which I don't believe in, which we're doing at crazier and crazier amounts. That for me, that's why both gold and Bitcoin is in my block, because, hey man, I just don't like this money printing out of thin air business, right? Which we've been doing, and I think coming to an end. Now, The other thing that I want to talk about that is at an all-time high is national debt. And you don't you don't want this to be an all-time high, but it is. And if you look at it, oh God, I don't know what else to tell you guys, but this is just like the money supply, which goes in tandem with the amount of spending and debt. The U.S. national debt's almost at 40 trillion. We crossed 37 trillion. And the part that really gets to me is every time we come to this thing that they call the debt ceiling, right? Which is put there to put in some discipline so we don't overspend like a reckless teenager with a new credit card. What do? We raise the debt ceiling so that we can spend some more. And then when we hit that debt ceiling, well, we raise it again so we can spend some more. And then we keep raising it. And this is just a never-ending, infinite loop up. I mean, this is like giving a teenager an American Express like platinum card or just giving them a MasterCard. Just keep raising your credit, until forever. Just because you're the bank itself. The U.S. can print money as the U.S. dollar as a reserve currency. But, does this make any sense to you guys, right? Just an infinite raise the debt ceiling and print and spend more money until forever and ever. Makes you wonder, what was the point to begin with for even having a national debt ceiling? Like, why even have it? Well, obviously, in the beginning, the point of having it was to instill some discipline so that we don't do what we're doing today. That was the reason a debt ceiling was created to begin with. That's obvious. But now it's become something that's just a political tool, right, for other reasons. It's not, today it doesn't exist so that we have this spending discipline. Today it exists for other reasons, like political maneuvering, messaging, and all this other stuff that we use the debt ceiling for, but never for the discipline. And if you think that we can just keep doing this forever and ever and just keep raising the debt ceiling, then you would have lost the narrative of why it was even created in the first place. And it was created because they knew in the beginning, right? The founding fathers and people before us knew that this is a path to destruction. That's why they created it. Now that we're on this path to destruction, we just want to forget about why it even existed, right? It's amnesia. And this is a very dangerous kind of amnesia that can lead entire nations into ruin if it's not dealt with. Mark my words, this is not the first civilization that has gone through this, right? And this goes all the way back to the Romans, all the way up to now, even the Egyptians before, right? But it is not new. It is a recurring cycle. This is stuff that Ray Dalio and all the other people have studied, the historical past of money and the economy and debt, and it's something that we're just going through right now. So this charade continues, right? And I just wanted to show this. I mean, this is just like, every household owes the government $441,000, almost $500,000 just to pay back our debt. This is clearly escape velocity has been achieved. Nobody's going to be paying back that debt. Now, what has happened as a result of all that debt is it's just more expensive now to raise debt, right? Because, and I showed this chart before, ever since COVID where they printed money like crazy, everybody is now like saying, look, you have so much debt, you printed so much money. Now, if you want me to borrow more of your debt, you're going to have to give me a higher interest rate because I ain't touching that stuff. You're never going to pay it off. So that's risky stuff to me, man. So if you want me to borrow some of that, buy some of that debt, you got to give me a higher percent before I buy it, right? Because that stuff is risky now. It's not, I don't think you're going to be paying it back. I don't know. So that's why the long-term interest rates for national sovereign debt just keeps going up for many, many of the developed nations countries that have been playing this print the money game. Think about it. This is the end game we're approaching here, right? It's not just one country. It's all of them. The long end of the yield curve of their debt are all together going up. And where it stops, nobody knows, right? But the direction is pretty clear of where it's going. Okay, we reach my favorite asset, which is gold. And I'm not going to harp on gold too much because if you've been watching me, you know I'm a gold bug. You know I've been buying and accumulating gold for many years now and how I've done pretty well. And I do want to just show a few charts here regarding gold. And the first one I want to show you is that gold has now set a new inflation-adjusted peak. Okay, so while we can, so the yellow line is the price of gold, right? The nominal price. And we are, you know, over 3,600. The peak before is at 1,000 in 1980, and we have shot high. But now if you adjust it for inflation, you don't see it here, but we just eclipsed the high in 1980, right? So that means the real price of gold is at an all-time record. And that is hugely significant because gold goes up when there's problems with the financial plumbing and system itself, right? And people get scared of the system, like the system might blow up, gold goes up. That is the simplest indicator of how you know things aren't well with the plumbing of the financial system and that there might be some problems sooner. Than the higher the price gold goes, the sooner that problem of some breakage happening is coming. We're pulling it forward. You know, people ask me like, how do you know? You know, you could be saying, well, the thing's gonna doomsday for 10 years and the stock market. That's true. You don't know. Nobody has a crystal ball, even if you understand that the system is not great, right? But the one thing that you can look at is gold. And the one thing you can understand is even if you can't time the market because nobody's Nostradamus, what you can know is that if gold continues to skyrocket, that's telling you that the chance of something, you know, breaking, right, is going up, which means that when it would blow up is coming sooner and sooner, right? Even if you don't know the exact date because nobody really can. The other thing I want to just mention here is, now this is the nominal price of gold, but if you look at it, we are at, now this is a technical analysis, okay? So there's something called the relative strength index, and that's how, you know, how much basically the buying, you know, power of a particular investment is. And in gold's case, we're at pretty much one of the all-time highs, right? And whenever we get into these like really high, you know, relative strength index, right, we tend to have consolidation or some kind of a correction here. So we're here, right? And so does that mean that we're definitely going to have a correction here? No, not necessarily, right? This could continue to go up even, like it did. It went up even higher a little bit. Remember, this is many decades, right? So a thing like this could be a month or 2 months even. So we could even go up higher for a month or two and really blow off. But what this is telling you is at some point you can't reach 100, right? That's a hard limit here. You can't go 100 RSI. Okay, so all I'm saying is that there is a limit here. There's a hard ceiling on how much the RSI can go. So that means there's a limit to the upside here, and most likely we'll have some kind of a consolidation. And this is why I actually sold my physical gold, took profits, and I'm in a much more liquid, okay, derivative of gold, which is the gold miners, which is a lot easier to buy and sell on the exchange than selling my physical gold. And so I'm into that instrument because I want to be able to, you know, manage this situation here. Should it arise, I can go in and out really quickly while still making a lot of profit. And this is what I'm talking about. I'm in GDX, and, you know, ever since the last about a month or so I've been in GDX, I've ridden this massive move up. And it's really easy for me to get in and get out and get in and get out again of GTX, reducing my risk in case there is that correction in gold, right? Which would be a lot more expensive for me to go in and out in physical bullion. And I'm going to keep doing that until I feel that we're getting closer and closer to that big problem where the system resets, in which I will take all of my profits from GDX, which is gold miner stocks, and buy more physical gold at that point in time. Now, CPI, we're done with all the all-time high, right? Now we're going to talk about the last two things, which is the CPI and the real economy, which is jobs. Now, CPI, okay, now with CPI, after the COVID money printing bomb, right? We had inflation go up, which means they had to keep raising interest rates, and then CPI kind of went down, and then we kind of flatlined, and now we're starting, you see this uptrend? We're starting to go back up, right? We're starting to go back up. And, you know, as I mentioned in my previous episode, the way they calculate CPI has increasingly been relying on estimations or money out of thin air type of, calculation. And what they call like cell imputation, right, which I went into a deep dive in an earlier episode, you can see that their guesswork basically, and not doing survey-based data, but just guessing, right, calculating through cell imputation, has gone up from the historical average around 10, 12% to over 35% as of May. And what has happened since May? It has only gone up. Now we're into August. We're almost at 40%, right? And we're basically, the BLS, or Bureau of Labor Statistics, is relying more on guesswork with less data collection, right, to derive the CPI. Now you can argue why that has gone down. Trump and Doge fired a lot of people. They don't have enough people to go and do survey data, or maybe something more, nefarious. I don't know. The fact is, there's more guesswork going on, more than before, almost 3 times more than before. So the CPI number you're seeing now, largely questionable, especially when you look at the jobs data and the revisions down, which I'll talk about in a little bit. But so almost half the data is being guessed, right? That's one thing that I wanted to mention. And while CPI has been not high, and people are saying, well, you see, tariffs didn't increase CPI, what's been going on is that basically this is the producer price index, right? What's been going on is the companies have been stomaching the higher increase in cost to produce something from the tariffs, right? And if you look at this, right, what it's showing you here is eventually they're going to have to follow back down, meaning the companies stomaching, right, the higher costs and not passing it down to the consumer is going to have to end, because the companies are going to go bankrupt, their earnings are going to go down. They're going to have to pass on the price of higher prices to the consumer. They can't keep stomaching the increased input cost forever. And that's a really key thing, because that means the lag of the tariff impact to CPI has been extended by these companies stomaching the pain. But that's not going to last forever and ever. And that's when you're going to see potentially an increase in CPI. Now I want to play this clip with Mohammed Al-Aram from what used to be PIMCO with Bill Gross. Bill Gross used to be the bond king. And Mohammed is pretty even keel when it comes to his analysis. So he talks a little bit about why the inflation data hasn't been so high, even though tariffs have been implemented. Let's take a listen over here.
There's the exporter, there's the importer, and there's the consumer. And so far, the consumer is carrying the least of the burden. I can tell you what's going on right now in companies is they're going product by product, going through the elasticities, what they think the consumer can absorb in terms of price increase without destroying demand.
So he brings a really important point here. There's the consumer, the importer, and the exporter, right? And basically, ever since the tariff, implementation, it's the exporter and the importer who have been basically hurt by the higher prices, not the consumer. So exporter being like, Toyota in Japan, they've been eating up costs and losing profits, or, the importer, the companies who take in the higher input costs to produce stuff, they haven't been passing down to the consumer the higher prices, because if they did, they would destroy demand, and then demand would go down and their company revenues would go down, and that would just not be good for the company. And so what he's saying is that that's been going on. That's why you don't see the high inflation and CPI showing up. And he uses the word not yet, right?
And they're finding out that they cannot pass through as much of the price increase as they want.
So, and he's saying, so present tense, they're finding out they can't price. So, they're looking at all of their products and services, and one by one, they're going, how elastic is this? Meaning, how critical is it for the consumer? Is it something that's a frivolous spend, or is it really important for the consumer to have? And based on that, they will try and, they have to go to that granular level to adjust prices to avoid destroying demand. But what he's saying in present tense, and this is a video just recently, is that they're finding out that they can't do it. So that means, and this is what, that production price index chart where they've been holding up the price, that's going to come down, right? And so that only means that inflation is going to go up. Inflation's going to go up because finally it's going to come and percolate into the consumer, which is where you're going to see the CPI data and the inflation numbers start to rise again. And what that means is we may follow, right? What happened in the 70s where there was this, and I showed this to you before, the spike up and then it went down and then a second even higher spike up of inflation back in the 70s, right? Towards the late 70s. That's why gold, hit that all-time high record of 1,000 back then. Remember, gold actually in the 70s did a 10x, okay, 10 times price increase. Well, we might be following that path here, right? This is what may happen. So that's what's going on with CPI. Look for PPI, right? Look for inflation to go up as less, all the estimation and guesswork, right, has been going on, and the producers stomaching like all the increased cost, right? And we're seeing this going on, and what they're about to do with cutting rates, right, which I'll talk about. You'll see that happening, and you'll see that we may be at this risk over here. And so the last thing I wanted to talk about is jobs, okay? So this is the final sign of the economy and how it's doing, and the jobs market has been deteriorating, folks, right? And I just wanted to point out that, and I talked about this in my earlier episodes as well, but we just had the first monthly negative print after all the downward revisions, and the August 22 jobs data was pretty low as well, so this was not good. So basically, we're starting to see the real economy and jobs starting to deteriorate with all the downward revisions. Now, in the last episode, I told you that we are looking at an annual downward revisions up to 1 million, right? And that's essentially what happened. So a week ago, I said we're going to be facing that. And guess what? We got that. Million job revision downwards, meaning for the entire year, there was 1 million less jobs created than they originally reported to, which is crazy if you think about it. And so the stock market has been going up whatever jobs print saying, oh, look, we created a lot of jobs. Stock market kept going up. And then they go, oh, by the way, all those jobs didn't get created, but then stock market goes up, right? Does that make any sense? Not to me, but that's what's going on because it's sentiment-driven trading going on with the stock market. But this is a clear signal, look, that the economy is starting to deteriorate with people losing their jobs and less jobs are being open for people to apply for. And if you look at, this is a crazy downward revision, right, that we're seeing. Mark my words, this is not something insignificant. This is something that you're going to, and it was also for 2024. So it's not just, it's not just this year. It's been 2 years of 800, 900,000 job revisions downward. So basically, the real economy is slowly starting to lose steam here. That's why the Fed and Powell pivoted in the Jackson Hole speech thinking, hey, based on data, we may need to lower interest rates, right? So that's why now it's almost fully priced in that September we'll see an interest rate cut. Yet, as I showed you, the CPI data, number one, is based on a lot of estimates, 40% up to, which is based on the jobs probably going to get revised upwards. And then we're seeing a delayed impact from all the companies stomaching the higher input costs and not passing it down to consumers yet. And then if you see that, basically inflation has this problem of probably going up while the Fed is lowering the interest rates down, and at the same time debt exploding, you're starting to see the overall picture of what I was talking about why this is a dangerous situation, right? And that you should start preparing for the increasing risk of something blowing up, potentially leading to a full financial system reset in the coming years. And to do that, that's something I can talk about in future episodes, but clearly, what I've been doing is accumulating a lot of gold and gold indexed instruments, as well as getting, other ways to protect, such as alternative pathways, which include Bitcoin and, playing the stock market in certain situations where if it does correct, I would benefit from it rather than being hurt by it. So I hope this gives everybody who's watching this episode a good, reflection of the current state of scenario and situation before the Fed starts cutting rates and starts its rate cutting cycles, which will continue for basically half a year onwards, and what that potentially means to the stock market, to all the other asset classes that I mentioned, and how one needs to start thinking about how to prepare for what is coming, which is most likely a recession and stagflation into your daily lives. So thanks for watching. I hope you enjoyed this episode. If you did, please like and share so other people can also share in this information. And I'll see you next week in the next FoFty episode. Peace out.